How to start investing in 7 simple steps. In this video, we show you how to start investing in just 7 simple steps. One of the simplest methods to generate money while you sleep is to invest. While you certainly could invest in anything, the most trustworthy investments are stocks, bonds, and real estate. And here's how you can get started with investing. But before we proceed, I'd like to give a quick disclaimer. I may have experience in finance, but I am not in any way a financial advisor. I only deliver knowledge in a fun, exciting, and informative way. So, if your money is experiencing a serious decline, I strongly suggest that you hire a financial advisor to help you with your situation. Investing is the process of putting money into something in the hopes of receiving a return on your investment over time. It's how your money works when you're sleeping. If you're new here, then it would mean a lot to us if you subscribe to our channel. Get more life-changing, mindset-shifting, and informative content regularly, only here at WealthMatic. Now I will go now into how to start investing in 7 simple steps. But first, let me start by dispelling these 2 popular myths. Number 1, investing isn't complicated. And number 2, investing isn't gambling. First of all, make a distinction between your short-term and long-term financial strategy. This stage is to split your short-term and long-term investment plans after you've determined how much cash you could save each month. Make sure you're not putting all of your money into the same account. First, investing in short-term, around 5 years or sooner. You should not risk losing any of your money if you need it in the next 5 years. A deposit on a home, college expenditures, money for a car, or money for vacation are all examples of money you could need in the next 5 years or less. You might assume that putting your money in a savings account is a good idea, but most term deposits pay only less than 0.01% interest, so you're really losing money due to inflation. I could barely believe this when I first heard of it, but by holding short-term assets in low-interest savings accounts, Americans lose almost a staggering $50 billion in interest. So in light of that, put your short-term investments here instead. A. Online high-interest savings account. There are a huge number of great online savings accounts with interest rates at 1% to 2%, so at least your money will keep up with inflation. And B. Certificate of Deposit account, aka a CD ladder. When you buy a certification of deposit from a bank, you can usually lock in a rate above 2% and even sometimes higher. The one catch is that you have to keep your money locked up for a defined period of time. However, an easy way to avoid locking up all of your money is to build a CD ladder where you stagger the CDs that you open so they end at different dates in the future, and then roll over into new CDs. So now you have some money in CDs that mature in 6 months, or in 1 year, in 2 years, however you want to build them. Then you will always have money maturing if you need to get it out early. Now let's go over to investments with a long time horizon, 5 years or more. Any cash you plan to spend in the next 10 years or more is considered a long-term commitment. Because this will be mostly used for retirement, you want to optimize your long-term return. This indicates that you should not deposit this money into savings. You intend to put the money into a retirement account. Number 2, choose your risk tolerance. Sadly, because 401k programs are primarily offered through a company, investment opportunities and expenses are often restricted. This implies that it's critical to choose your new 401k assets carefully. I usually advise new 401k participants to pick a model portfolio depending on the risk tolerance. The proportion of stocks and bonds in your investment portfolio is often referred to as your asset allocation. Now just a bit of advice. If you're under 35 and just getting started with your 401k, it's preferable to go with an aggressive growth strategy that's strongly weighted in equities. Number 3, determine how much money you have available to invest. You must first determine how often you can invest each paycheck, if it is $100 or $10. Every last little bit adds up, and you should constantly aim to put as much as you can into your own investments. However, the more you pay into it, the harder it will work for you. Pick like a professional. Where should you put $500 right now? Many experienced investors take chances on long shots. Amazon, Netflix, and Apple are among my favorite companies, and they're also on my list of the greatest stocks for beginners. Number 4, put as much money in tax advantage funds as you can. You want to reduce your fees as much as possible, since they are one of the largest drags on your investment profits. The top aim for most experienced investors is to put as much cash as possible into tax-advantaged funds, where their money may grow tax-free throughout time. Moving on to number 5. Choose what gets into your long-term investment accounts for retiring. Both the 401k and the IRA are investment opportunities that are commonly used to save for old age. They are not an investment in and of themselves. This implies that you'll need to decide on additional investments to put your money towards. When it comes to investing, there are virtually a limitless amount of options, yet most of the time, the simple stuff is the better. As you gain more experience as an investor, you may find that a target date fund makes you less sense because you may receive smaller incremental returns on investment in your IRA in the mix of low-cost index funds that have reduced fees over time. However, for a rookie investor, there aren't many better options than a target date retirement account with a stock allocation of 90% or more. While some investors think target date retirement accounts are overly simplistic, I know a number of elite finance and private investing experts who use them to invest their own cash. Number 6. Invest as soon as possible, as often as possible, and while you can. Being a millennial, I realized that despite the fact that my new job didn't pay much, I had one advantage, and that's time. Time is the main aspect of investment since money grows over time, and the more you have, the better. The more opportunities for compounding interest to build your money, the better. You continue to profit from your rising interest, and as you add to that sum of funds, it multiplies over time, allowing you to profit from your own cash. This simple concept is what makes investing so effective over time. Here's an easy way to understand compounding. The more and sooner you invest, the quicker your money will increase. Heading on to the final strategy in this list, number 7. Keep track of your assets and net worth. When you first begin investing, one of the most convenient methods to keep track of your funds is to use a free investment monitor. If you take these steps outlined above, you should be well on your path to accumulating money and eventually eliminating the need to work. And that concludes our video for today. Please like and subscribe if you appreciated our content. If you want to elevate your life from the one that you have to the one that you deserve, be sure to click the subscribe button right now. This has been the one and only WealthMatic, and we will see you on our next video.